Good morning, Jonathan. Good morning, everybody. Let's see. Got a couple of things that I wanted to point out. Let's go ahead and start like we normally would. Looking at FX Street and what's on the agenda for today. This is the Fed Fund Watch tool. The other day I was showing it and we had like a 60% chance of getting a 50 basis point rate hike in September versus like a 40% chance of getting a 75% rate hike in September. Now those have swapped around, and I had said if this swaps around, that means they're going to have to price back in a 75 basis point rate hike. When the CPI numbers came out on the 10th, the market had anticipated a 75 basis point, but when CPI came out, they unwound that to a 50 basis point. So there's this 25 points that's being kind of shuffled around. They take it in, they pull it out. They take it in, they pull it out. Well, on August 10, they pulled it out. They unwound that 25 basis points, and the market really moved up when that happened, which, it makes sense, right? Because we're only going to get a 50 basis point rather than a 75 basis point. Market had that nice little rally. Well, in the last 2 or 3 days, these have flipped over, meaning now the market really does think that it's going to be a 75 basis point rather than a 50 basis point, and they're pricing it back in. And where did the market fall back down to? It fell right back down to where we were before that CPI report came out, right? So the gray line, or this candle right here, this is the week of the CPI. That's the day of the CPI when the report came out. The CPI report kind of gave everybody the idea that the Fed was going to kind of soften its tone a little bit, be a little dovish, and hit us with 50 rather than 75. And we priced that in, or I should say, we unwound that 75 points and moved it into a 50 point. Now, the Fed said, hey, we never said anything about going to 50. We're still looking at going to 75. Nothing's changed. You guys just completely misunderstood our data points, and now the market is pricing back in. So, it's not like we don't have some kind of roadmap for where the market's headed on a week-to-week basis, right? Other than the irrationality of it all, the fear and greed that kicks in and drives markets to move just a little farther than we would have anticipated on a day-to-day basis. But right, so I just wanted to throw that out there. Keep your eye on that Fed Watch tool. It provides a lot of insight on what the market is doing on a day-to-day basis. One way to find that tool is just to go to Google and type in Fed Watch tool. But you could also type in CME Fed Watch tools, anything like that. You'll find it on Google. They do have users guides, how to use it, demos, uh, like how-tos. All right, strong dollar across every single currency. We actually broke parity with the euro again and are really breaking down on that side. Everything's about Jackson Hole this week. We are going to get some more data points this morning, but they're not expected to be overly volatile in the report. Kashari speaks at 7 o'clock tonight. It'd be way too late to affect our intraday market, so not a huge deal there. It's all going to be Friday at Jackson Hole. Everybody's going to be looking for Powell to kind of shine some light, and what he's going to try to Operation Don't Rock the Boat. He's going to try to talk out of the side of his head, blah blah blah, with words coming out without having any real impact or meaning. That's what he's going to try to do, of course. But on the other hand, he also does need to kind of get it across that, and I thought they did a clear job of this before. They're not going to quit raising rates. They're not going to pivot or pause, which is what the market keeps thinking. Ooh, they're going to pause. The Fed said they're not going to pivot or pause unless the data is overwhelmingly convincing that this inflation is abating, right? And so, I mean, I don't know how more clear they can get than that, but I'm pretty sure that's what he's going to be reiterating in Jackson Hole. But he may also point out which data points they're going to be more focused on, right? Because sometimes it's really important for them. They'll watch like job numbers, and then it'll be some other metric, and they'll say, "Well, we're throwing that out the window. We're changing all the rules, and now we're going to watch the PPI, or they like the CPI. We like the PPI. We're going to watch this, and when we get these numbers, then we'll change." So the market's going to be listening for him to give us some clarity. So we got PMI composite flash at 9:45. If you want to learn more about this, you can go to the Econo Day website. They'll have everything that is written right in here, only on a bigger spot, so you can kind of dig deeper into it. 10 a.m., 11, and 1 o'clock. Those 1 o'clock auctions, they're worth keeping your eye on, right? A lot of our midday reversals, or um, a lot of those days where the market just completely changes in the afternoon session, very often it's on these days. So we're not going to get much of a lunch because we have the 11 o'clock auction. I would anticipate a little bit of a reaction around 11, get a late lunch, say around 11:30. And then as we come back into 1 o'clock, be on the lookout for any breaking pivot, right? Like a breaking out above yesterday's level, breaking down below yesterday's level. Be really watching for an absolute shift of sentiment right around that 1 o'clock time frame. We get past one, smooth sailing into the close. I updated the video that I had made on expansion candles, a candle like August 10. The video that I had made originally was on May 5. It was when the market had, it was a May 10. The market had a 10% move in a single day. When you see the NASDAQ make a 5% move in a single day, it's a pretty significant move, right? And I had done a video on that. I updated it yesterday. It's how can we trust a move like this, right? How many of you traded that yesterday, and how much of it did you get, and how comfortable with the move was you? Normally, the market makes a reasonably decent move, and then we try running it the other way. We go counter trend, right? Because it makes sense. Usually, we get a reasonably decent move, a 1.5% move or something like that. And we kind of stall out, flip over, and we take the counter trend trade. But not on a day like yesterday. So it's worth checking that out. Um, I haven't made a version for the bullish bears yet. I plan on doing that video in the next few days. So you'll have to catch that one off of my YouTube, not theirs. But I will be getting it done for the next level, right? Just I do a deeper version of it for the next level library on the bullish bears. All right, as you can see, the volume's a little heavy compared to some of these days, but we're in line with some of these others. So the idea behind looking at this cumulative volume down here is we're looking for something really, really light. Say we can't even get, 50,000, or we're looking for something really heavy and we break above that red line. At any other time, it's just a noise, right? Like most indicators are. Most of the time, an indicator isn't giving you a signal, it's just noise. There's very few real signals in there. And when it's not that, then you basically ignore it. So we look, we can see, yeah, we're not really light and we're not really heavy, kind of basing around the middle. Good enough. We just turn it off, right? Get it out of the way. We are still well below the weekly pivot. That puts us into bearish territory. Like, thanks, Captain Obvious. Got that figured out. We got this really broadened head and shoulders forming right now. Be a like a way over here is the left shoulder, and then the head. Be looking for a right shoulder. Break over measures up to about the full ADR. Right now, we are in an MDP. That's a missed daily pivot, which is actually a fully formed trading strategy if you were to go seek it out. The MDP, I don't necessarily trade an MDP, not on its own merit, but it does provide context in my analysis, right? When I'm looking around and kind of looking at where the pivot points are, I recognize whether or not we've hit that pivot point and what that portends, right? What that signifies. So it's worth checking out, but we haven't hit the pivot point today. Markets generally hit their pivot point more than 80% of the time. So when we're in the other 20, it's worth noting, recognizing. We did get really close to half of the ADR, which is also really close to the COG line. That would be 4111. And we're right into that zone where we were when the CPI report came out, right? And it was that morning where the market exploded higher and just kept on going, and we had its beautiful, strong rip and rally. We do still have the gap if we happen to start working our way back up from Sunday night. The base case argument is that we're going to hold the range here. The range would be inside of yesterday's low up to at least yesterday's cash session high. And that would be one zone that I would focus on. Another zone, if we get back below yesterday's low, which would be an inside day breakout, is the low of our own Globex. And then if we break above yesterday's cash open, then we would want to focus on all of yesterday's price action, which would put us up to the Globex open of Sunday night, or I should say the close of Friday, because we opened gapped down. Right, so that's three different zones. The most important would be the middle zone, right? It'd be the cash session of yesterday. It's very likely in a base case argument that that would be our day today if we're all on wait for the Fed. Right? If we're all looking at Jackson Hole and waiting on the numbers and waiting on some insight, then we're very likely going to see more and more muted activity, lower and lower volumes, maybe choppier price action, bigger spikes, because on the lower volume, price can move farther. And just seeing the market hold this low, hold this base. Now, that's our strongest possible outcome. But there's always three outcomes that a market could give us. So if the base argument is that we hold the range inside of yesterday's range and we have an inside day today, then the other arguments would be that we break out to the upside or that we break out to the downside. We'll cover the upside first since it's the least likely possible scenario. The upside breakout would be that we rally all the way up to the close of Friday, 42.28, and that we then break above that. Now, technically it's possible, but not probable, right? It's not very likely, but that would be a topside inside day breakout. To get there, we would have to get through the Globex high, the daily pivot point, the cash session of yesterday, the Globex low of yesterday, the Globex high of yesterday, the full ADR, the COG line, close the gap, and then get above Friday's level, Friday's close, and Friday's low. All of that, which technically we could do it, right? We just don't see it likely. So if we do start making those moves to the upside, every one of those pivots becomes your goalpost and your signpost, right? You look at it from the perspective of where are we now and where are we going? Okay, we got to that pivot point. What's the next pivot point? When we got to this one, did we bounce or hold the line? What was the buyers and sellers doing? Did they defend that level? Is there a large trader sitting above us? Is there a large trader sitting below us? Right? Look at those flows on the dome and then work towards the next pivot, the next level, the next pivot, the next level, and work our way all the way up. The other scenario would be that we have our inside day breakout to the downside and that it sticks. We already broke outside of that thing once and we came back in. Um, it wasn't much of a breakout as much of as it was a liquidation break, right? Right around the kill zone, 2 a.m., we had that hard, significant drop to the downside and then just V bottomed right back out of it. All of that move was done in the kill zone between 2 to 4. And then we unwound it again. And it looks like we're just trying to get back to where the news moved us at 2 o'clock this morning. If we were to make that downside breakout, we'd have to get back down, cross the VWAP, break through yesterday's low, break through our own Globex low, get to the ADR half at 41.14, and then get to the full ADR at 40.82. We do have a midpoint really close to the round number. Honestly, instead of marking 40.98, you would be better off just marking 41.11. Because if we get that close, 41.11 is very likely going to be much more insightful and valuable than 40.98 would. Right now, we have an ADR of 1.5, and we're basically flat. So this market is sitting in the middle of the court, ready to make a move in either direction. It has the legs and the capacity to make that move. We hit the edges of the weekly expected move yesterday, broke down below it, and actually came back inside it. I'm going to zoom this in for a moment. I know it always sucks. 41, 46, 50. Now, when we get back into the intraday, we'll at least have our line there. So we broke down below the weekly expected move yesterday. We ended up getting back inside of it just barely. We want to keep our eye on the expansion out of that thing. The way that the algos work is those market firms, the ones that take the other side of your trade, the ones that very often are holding large amounts of options, they're not going to hold those large amounts of options naked, right? They're going to hedge that. They'll watch their deltas. So say they're short, a million, million five deltas. And I'm using an extreme number, but still. Options delta is liquid, it's fluid, it moves around. So if you wanted to hedge against those deltas, you wouldn't use options to do that. You'd use futures to do that. Futures have a hard delta. So they initiate their holdings with options, and then they hedge that with the futures. If we break down below the weekly expected move, they have to sell into selling to get back to delta neutral. If we break the top side of the weekly expected move, they have to buy into buying. Well, their buying would cause more buying, would generate a bigger move, which would get them more out of sync with their delta, and they'd have to buy more to get back to delta neutral. Same thing with the downside breakout. So it becomes like self-fulfilling. The more we fall, the more they sell because we fell. And then since they sold more, we fall more. And the more we fall, the more they sell because we fell. You see the vicious circle there. Now, when we just start tickling the edges of the weekly expected move, it's not that bad. What starts to get bad is when we expand like one standard deviation outside of the regular expected move. So definitely want to keep your eye on where that expected move level is. If you're on a broker that is not twin expected move level, you can get it by going here. Now, the one that I'm using is a static expected move. We got it last Friday. You want to get it after 6 o'clock on Friday night, or if you're getting it from the S&P after 4:15 on Friday night. Sometime over the weekend, just go into the options chain and look at the following Friday and mark it out. If you can't go where you didn't get it last week, then use a dynamic expected move. Use the one that is live and current, and that will target Friday's expected move for you. It's not going to be the same one that we're using, but you already lost that opportunity if you didn't mark it over the weekend. When it comes to this expected move level, there really are multiple ways to use it. One would be that static process that you picked today and you marked it out and you keep track of that expected move's distance between now and the countdown of that day. And then there's the dynamic one, the one that is constantly shifting and updating and being measured and remeasured. If we get out of the futures for a moment, look at a regular options chain. These levels here on the side are an implied volatility average, right? The average that it's using is the implied volatility in the out of the money options on that series. So we're looking at August 26th. It would be all of the options on the call side out of the money and all of the options on the put side out of the money. And it adds it all up and it gets an average. And that's where that value comes from. And then the expected move part of it, the money side of it, is they use this complex formula that is proprietary. They don't really share it, but we've got a little bit of an idea. It uses the square root of time and a lot of other nerd stuff thrown in there, and they derive that expected move. The SPX is showing a market maker move of 21. Keep your eye on that as we come into the open and see if it gets removed. It might still be using yesterday's data, right? Because the SPX, obviously, it quit trading at 4:15, and the futures market is still open, right? So technically closed, but I mean, it's still moving. It's still being traded. There's no market maker move on the ES, which is why one of these are going to turn on and the other one's going to turn off. So either the SPX is going to turn off as we come into the open, or the ES is going to get a market maker move. Just keep your eye on it, see which one you get. All right, we got the 10-day, 30-minute volume profile here. Just like the other day, volume by time is not showing the same amount as the volume by price. It's nothing too drastic or extreme. We just want to recognize that. We left the point of control a long ways away. When we're at the bottom of the box, generally speaking, we say we're headed towards the top, or if we're at the top, we're headed towards the bottom. We moved through that shallow area pretty quick, which was the expectation. If we broke through this level of volume, that we were likely to move through there relatively quickly, since there was nothing there to catch us. Right now, we're kind of at our last line of defense, that 4111 zone with a high volume. It is the value area low at 4113, which is really close to the cog line at 4111. If we break that, we'd have to look at a higher profile, which, we got one of those too. It's the 20-day 60-minute. On that one, we're at the point of control. We're there. We break that, and it's pretty shallow all the way down. We'd be looking at like 39. So we're pretty much at the make or break level. We still have some untouched point of controls. $40.73 is an untouched point of control. I don't see that we're going to get there today. That's the closest one that I've got for the next level down. Make sure I didn't miss one in here. Nope. As you can imagine, we leave that turned off, right? That would just be too much trash to leave on your chart all day. Can you imagine trying to trade with all that? What a mess. So you could carry forward the value area high of yesterday, but looking at it, it's really close to the high of yesterday, which is why I generally don't carry forward those anyways. I just carry over the open, high, low, close. We've already breached the point of control and the value area low, so we're not going to get any value or benefit out of those. And there is no other point of control to the downside to focus on that is near enough that I think we would hit today. But if we did get that topside breakout, we have a point of control that hasn't been hit yet at 42.30. I would carry that one forward. Although, that was the argument that was the least likely that we would rally up and break out of yesterday's range to the upside. But if we do, 42.30 has an untouched point of control. So definitely keep your eye out for that one. I just took everything off so we can see the candles really clear. And when it comes to drawing these support levels and trend lines, two way of doing things. Snap your line, move to the next pivot, and then let it go. All right, so that was the first one. And we broke through that because we went sideways for like a week, just chopping and chopping and chopping, and then we finally broke through it. Trend Spider would have that on there, but once it's been broken and we've gone through it, pretty much just want to let it fade in the background or just straight up get rid of it. The other way to do a trend line is that you snap your starting point, drag your line out, and then just swing up till you hit your pivot. Now that is ignoring the current move, because what we're looking for is before the move would have happened, right? When we were still in that consistent, persistent move up, where would the line have been snapped? Then the breakdown from there. Now that it's actually broken trend and headed to the downside, we don't want to snap this line, swing it out, and hit this. And that's because this pivot is still in play. Until it sets a low and starts to go back in the other direction, it's not a pivot yet. So this little doji that we got here, since the market, it just barely opened, needs to go to the upside so that this actually becomes a low, like that low and that low and that low, right? Until we get that, it's not a low to mark. It's not a low to hit with the swing. I wouldn't swing it over and catch it. So the reason I bring this up is if we do start to get that rally back to the upside, the line that was left behind here, trend line 2, is going to be like a minor resistance, a bit of like a Busby off the bottom of it if we get back up to that 4,300. Now, technically speaking, we broke it just like this other one back here. And we would just write it off and say, well, we're done with it. I would say leave it on until we get back above it. Because getting back above it very often means we're going to interact with it, and you'll, surprisingly enough, see a reaction at a price from it. So we're looking at here is weekly change percent. And the only thing in the green is energy. One of them that's red, but not red by very much, is staples, and then utilities, and then it starts to really get negative. Financials, nearly 4%. Consumer discretionary, nearly 5%. And then tech, more than 5%. Communications services, more than 6.25%. We're kind of flat this morning, so we want to take this question in both directions. What's gapped and by how much? So we'll start with the S&P. How many products are gapped down at least 0.5%? Only one. So let's take it the other way. How much is gapped up by 0.5%? 9. This isn't really very surprising. Most of the market's going to do what the S&P and the NASDAQ is doing. We're flat in the indexes, so we're basically flat here. But for the names that are up at least 0.5% in the S&P, we've got kind of a mixed bag. Energy, consumer durables, finance, technology, retail. It's across the board. It's a mixed bag, but definitely energy, right? We got more energy than anything else. Well, that's the S&P. So take the same question over to the NASDAQ. We'll start with the negative side. Three names are down at least 0.5%. Zoom, DocuSign, and AstraZeneca. Take it the other way. How many are up at least 0.5%? 15. There we go. Technology services is the biggest list. And then behind that, we've got electronic technology, health technology, a couple of retail names, and some consumer services. It's not much of a surprise, right? Because it's the NASDAQ. But we see some motor vehicle names, right? Tesla, Lucid, and then packaged software. Got a China name moving this morning. We got JD and Baidu. That might be worth digging into a little bit if we happen to see those China names start to come back around. Now, after we had such a big move in the last few days, we're almost guaranteed to take this pause, right? To have at the very least, this basing day that we've been focused on. That's not what we want. We need the futures. The ES has a 50 period moving average underneath it. We should be coming into contact with that today if we continue this move to the downside. Oh, I guess we already broke through it. All right, so that was yesterday then. I would keep track of it because if we got the 20, first there's the 20 week, and then there's the 50 week. Both of those are in play. I would definitely put those on your intraday chart. And then now when we come over to a daily chart, there's that 50 underneath us. Now, if you're on Thinkorswim, this is a pretty simple thing to do. If you're on a broker that isn't Thinkorswim and you don't have the indicators that I'm about to use, just mark your levels on the daily chart. See where the 50 is, draw a line, and then go into your intraday time frame. Your line will represent wherever that 50 is. On Thinkorswim, just type in the word daily and you get a daily SMA. Now, once you get it, it doesn't have to stay on the day, right? We know that there was a 20 period weekly, and there was a 50 period weekly, and then a 50-day. See, all of those are really far off. So this SMA ain't going to get it. We're going to need the EMA. Nope, that ain't it. There's the 2050 EMA, and then we want one more of those for the weekly. Sometimes it'd be faster or easier just to load the indicator and mark the line and call it good. All right, now I have mine turned into a cloud just so that we can see it easy. But you can see we've got four levels. If you think about where the cloud low is and the cloud high, one is the 20 and one is the 50. And then the same thing with this orange cloud. The low end of that orange cloud and the high end of that low cloud would be the 20 and the 50. So you've got your 2050 daily and your 2050 weekly. Both of those are EMA, not SMA. For the dashed line, that green line from yesterday right there, that was the 20 period moving average. And we cut right through it like it wasn't even there. Market didn't even slow down, just ripped right through it. The 50 week is sitting way up here. We got near it, didn't hit it, but we got darn close to it and gave up the ghost. So this leads us right back to what I was talking about. Keep your eye on those higher time frames. Look at where the major moving averages are. Ask that question every day. Hey, are we going to hit one of these things? Because if we're not going to hit it, and no big deal, right? And a lot of times, most of the time, we're not close enough to one of these levels, right? But you can see, like back here, we tangled up with the 20 week, and then when we finally got above that 20 week and we resolved it, we started to move beyond it. Now we're headed back towards it. So when you get towards those moving averages, be able to ask that question: Are we moving towards a major moving average, or are we moving farther away from that average? What's my expectation when we get there? We're going to bounce through that level, break through that level, get tangled up in it like we did back here, and then that leads us into our trade plan, right? Obviously, I wouldn't want these clouds on my chart all day. That'd be just nasty and distracting. You're better off just marking the line, marking the level, and then turning off anything that like this. The Discord that I built that has all these indicators in it, I made one that has a daily EMA and it isn't a cloud, so you wouldn't have to deal with that. Should be able to find it in there. I've got an entire section on just moving averages. So keep your eye on these major averages today because we're right there. We're in them. And you're definitely going to want to know if we hit them. Otherwise, with this capital rotation, continue to focus on where the money is with energy and the dollar. The dollar's been just really aggressive. Now, I mentioned looking for contango or backwardation in the VIX yesterday. Continue to do that, right? Look for those higher levels, the farther dated levels of the VIX. See if they're starting to fall below the front end. The line in the sand right now on the VIX, if we were to sell off and get crazy wild out there, it's 25.20. If we break above 25.20 in the VIX, we're very likely going to, get below 41, maybe 40 in the SPX. So it's a significant benchmark right now. We did close the gap. That needs to hold. And the last line of defense is 40.75. If they don't defend here and cover this 40.75, then it's going to get nasty, and we're very likely going to end up getting down around that 39 zone. At the moment, we still have a higher high, a higher low. And that's one of the main things we're focused on right now. Higher low, higher low. At the moment, still higher low. We get below that, then we're not going to have that higher low. All right, everybody. That's what I got for you guys. Be careful, be safe, have a good day. I'll see you all tomorrow at the morning briefing. It is my day to stream in the afternoon. Um, so I'll see you guys this afternoon.